Good evening, ladies and gentlemen. A very warm welcome to all our participants, dignitaries, and our esteemed guest speakers to the seminar on commodities importance as an asset class organized by the IMC Chamber of Commerce and Industry in association with MCX IPF. All participants will be muted to avoid any disturbances during the course of the session. To consume less bandwidth and have clarity, you may like to stop video streaming at your end. Kindly post all your relevant queries and the feedback of the session in the chat section so that the same can be addressed during Q&A sessions. As we begin the session, may I request Mr. Rajiv Poddar, President, IMC Chamber of Commerce and Industry, to present the welcome address. Over to you, sir.
Thank you, Sebi. Thank you. My eminent speakers, panelists, good evening, ladies and gentlemen. It gives me immense pleasure to welcome each one of you to this interesting seminar on commodities importance as an asset class organized by IMC in partnership with MCX IPF. The COVID-19 pandemic has taken a heavy toll on the global economy, and India is no exception to it. The Indian economy is currently facing an unprecedented challenge in the form of economic slowdown. Indian policymakers, central and state governments, along with RBI, have been taking supportive steps for providing relief to the economy. Encouragingly, the announcement by the Honorable Prime Minister Shri Narendra Modi ji on the Atmanirbhar Bharat Abhiyan in May 2020 amalgamated many policy interventions with a total corpus of approximately 22 lakh crores. Policy intervention triggered under the Atmanirbhar Bharat Abhiyan has been complemented by other announcements by associate policies encompassing the 4 Ls: land, labor, liquidity, and legal framework. Further, the government recently announced a series of reforms for agri markets which will help advance the objective of doubling farmers' income. In our opinion, these reforms will provide an impetus for the agriculture sector, while in the long run, they will ensure India's food security and efficient supply chain in a self-sufficient manner. India is the largest producer of several commodities and has a long history of commodity trading. Commodity markets are driven by a host of factors, global and domestic. This gives rise to a unique opportunity for investments in commodities by taking trading position in commodity contracts traded on exchanges. Further, future contracts and options contracts are available. Index trading has also been permitted. It is in this background that IMC Chamber of Commerce and Industry, in association with MCX, India's leading commodity exchange, has organized this seminar. As you know, IMC is a Sebi accredited training institution for commodity derivatives. Friends, for this webinar, we have with us speakers of domain expertise representing some of the well-known names in the industry. Their views on commodities as an asset class will surely benefit all participants. I am grateful to our panelists for the day, Mr. Chandrasekhar ji, Economic Advisor IMC and Director IMC ERTF, Mr. Rishi Nathani ji, Head Business Development and Marketing MCX Limited, Mr. Tyagarajan ji, Owner Competence Research, for sparing their valuable time and being with us today. Before I conclude, I would like to say a few words about IMC. Established in 1907 and having its headquarters in the heart of the city of Mumbai, the IMC Chamber of Commerce and Industry is an apex chamber of commerce, trade and industry in the western region with a membership base of over 5,000 members and over 150 trade associations affiliated to it. Together, it represents and advocates interests of over 4 lakh businesses and industry establishments across the country from diverse sectors of the industry. The theme of the chamber this year is Reboot, Reform and Research. These three factors are going to be crucial for India and other economies globally reeling under the impact of the pandemic. Once again, I welcome you all to this interesting event. I'm sure you'll go back enriched. Thank you very much.
Thank you, Mr. Poddar. May I now request our esteemed speaker, Mr. G. Chandrasekhar, Director, IMC ERTF and Economic Advisor, IMC ERTF, to address the participants. Over to you, Mr. Chandrasekhar.
So you're on the mute.
So you're mute, 1 minute. You're mute. Please unmute yourself, sir. No. You have not unmuted. Yeah.
All right. Okay. Friends, yeah, I'm okay. Mr. President, thank you very much for this very inspiring speech, welcome speech. It's such a delight again for me personally to welcome all.
Hello?
Sebi, did you say anything?
Yeah, you're breaking, sir. I would just request you to close your video because it's not carrying. Your network bandwidth is very
Stop
low.
the video. I'll stop my video.
Yeah. Stop the video.
All right. Oh, is that now audible? Clear?
Yeah. Now
okay,
it is audible.
It's such a delight for me to be here, and I'm beholden to MCX for actually asking us to organize this event during the World Investment Week. We are celebrating the World Investment Week from the 23rd of this month till the 29th. So today technically is the last working day for the World Investment Week, and the theme for today's discussion is actually commodities as an asset class. Now, some of you may not probably know what commodities are, because everybody talks about commodities, but commodities don't have a formal definition. And therefore, we need to understand the word commodities by their characteristic features. So what are the characteristic features of commodities? One, commodities are goods with economic value. Number two, commodities are produced and traded in bulk. Number three, commodities are often raw material for further processing. So these are characteristic features of commodities. And when these commodities come to the marketplace for being traded, they become tradable commodities. Now, commodities have actually been with us for centuries, even millennia, when actually mankind started agriculture, and mankind produced more crops than he can consume, and he started to trade, he started to barter agriculture commodities. I think the commodity markets were born at that point of time. Obviously, it was several thousand years ago. But for commodities to emerge as an asset class where somebody can actually invest money, it's a very recent phenomenon. I think it's only in the last 20 years, from the turn of the century, that commodities have actually been now accepted as an asset class, as assets where investors can put their money. While equities are generally perceived as investment asset class, and commodities are generally perceived as consumption asset class, in recent years, that is over the last 20 years, commodities have also started to attract investment. Commodities have become, I would call, investors' delight. Today, as an asset class, commodities are in the same league as equities or stocks, bonds, and even foreign exchange. And therefore, commodities are seen more as a portfolio diversifier as far as investors are concerned. And there is a rising investor interest in commodities these days. And I must mention, media has certainly played a reasonably good role in popularizing commodities amongst all these stakeholders. Now, why are commodities becoming more and more the favorite of investors? Often, commodities have outperformed other asset classes. A commodity investment has given much better returns than investment in even equities or real estate or bonds. And therefore, financial investors are now increasingly getting attracted to commodities also, in addition, of course, to equities and bonds, etc., etc. Now, if I will give you two examples. One is gold, the other one is crude oil. And all of us know gold and crude oil are such classic examples of commodities as an investment asset, because they have delivered extraordinary returns over the last 20 years to investors. Gold, for example, by gold prices increased from 2001 to 2012, double-digit increase in prices year on year. Extraordinary bull run that gold had. And you can imagine if you had invested in gold during that period. Even closer to the current time, look at how gold prices have moved up between, say, April and September, October this year. Awesome rally that we have seen in the gold market. Same with crude oil. There was a time in 2008-9 when crude oil went to nearly $100 Brent. Then there was a collapse. Then again it started to rise. I remember February 2016, Brent was less than $30. And we at IMC had several events that time, and that forecast that the prices would rise 40, 45, $50. Exactly that happened in 2016 and 17 and 18, etc. Then again, there was a big collapse in crude oil prices in early this year because of the pandemic. And again, you can see now Brent $46 or $47 a barrel. Huge volatility and huge opportunity for making money when one invests in commodities, like for example gold or silver or crude oil. And therefore investors are now flocking all these commodities, not around the world, not only around the world, but certainly also in India. And remember, in the United States, commodity markets are bigger than the equities market. It may come as a surprise to many people, but in the US, commodity markets are bigger than the equities market. And there is a huge amount of institutional investor interest in commodities.
Again, I think so.
Hello, Mr. Chandrasekhar. Hello,
Disconnected.
Mr. Chandrasekhar.
Lost his connection.
Hello. Hello, Mr. Chandrasekhar. I think he's lost connection. Can I take up the next speaker if the speaker is okay with that?
Yeah, I'm fine.
Okay, sir. So may I request our esteemed speaker?
Sir has come back.
Okay, he's come back. Yeah.
So you.
Okay, sir. Okay, I'll just unmute yourself, sir.
All right.
1 minute.
Done. It is done. I think I'll just.
Your connectivity is very.
I'm okay. I think you're able to hear me now.
Yeah. Close your video, sir. Close your video. No, again your connection has gone off.
Can you hear me?
Yeah. Now we can hear you.
Okay. I will stop my video.
Yes,
okay.
Yes.
All right.
Yes.
Therefore, I'll just continue from where I left off. I remember in the US, commodity markets are bigger than equity market, and there's a huge amount of institutional investor interest, including banks, hedge funds, mutual funds, pension funds, etc. Look at China. While the US is the world's largest economy, $19 trillion. Look at the world's second largest, China, $12 to $13 trillion economy. Over the last 25 years, China's miraculous growth story was substantially driven by commodity markets, commodity production, commodity consumption, and commodity trade, both import and export trade. Commodities have played a very significant role, whether it is crude oil or steel or iron ore or copper or soybean or cotton. I think China has been the mover and shaker of the global commodities market. Now, where are we? Where is India? Where does India stand in this situation? I am absolutely convinced the next turn for boosting commodities is India's turn. India is in the queue now waiting to explode as far as commodity markets are concerned. Our economic growth, India's economic growth over the next 5 years will be significantly commodity intensive, will be significantly commodity driven. We are already major producers of commodities, major processors of commodities, major consumers of commodities, major exporters and importers of commodities. This position will be well entrenched, and in fact the volumes will only expand going forward over the next 15 to 20 years. And our exposure will include energy products, will include all kinds of metals, precious metals, industrial metals, base metals, and a wide range of agriculture commodities. Now, if commodities, because commodities are so important and they have emerged actually as an asset class, there is obviously a great propensity for investors to invest in commodities. But remember, commodity markets by their very nature are volatile. Commodity prices are volatile. If and this volatility, of course, for traders creates an opportunity. But investors must exercise a certain amount of caution, because investors in commodities need to have adequate product knowledge and market knowledge. So first gain adequate product knowledge and market knowledge, and then start looking at commodities. And commodities will surely give you far better returns than other asset classes. So investors will have to stay very well glued to market drivers and market dynamics, and there are a host of market drivers. Also, investors, particularly retail investors, must be very clear about their entry and exit strategies. They should know when to enter the market. And more important than the entry strategy is the exit strategy. They should know when to exit the market, which is more critical. So given all this, we have Sebi as a market regulator, which is Sebi is an autonomous regulator. So to deepen and widen the market, Sebi has recently allowed new products and new participants. They've allowed new participants in the form of mutual funds. Mutual funds can trade. Category 3 AIF can now trade commodity derivatives. Options trading has been permitted. Index trading has now been permitted. Indices have been launched by exchanges. Options trading, options contracts have been launched by exchanges. Therefore, the idea of Sebi is to widen and deepen the market, bring more participants, bring more products into the market. The next logical step, in my view, would be to allow banks to start trading commodity derivatives as a part of the bank's risk management policy. Now, there are several avenues for investment in commodities. You can, of course, invest in physical goods, which is the simplest. But you can also invest via futures contract. You can invest via options contract. You can invest in ETF, exchange traded funds. You can invest in index. So there are wide range of opportunities for investment in commodities, which are promoted by India's top class exchange such as MCX. Therefore, this is the overall message that I wanted to give, that commodities are an asset class. Commodities outperform other investment assets quite often. Have adequate product knowledge and market knowledge when you start investing in commodities. And I'm certain that commodities will not disappoint you. The returns that you will get from commodities from commodity investment will be very, very attractive. With this, I'll stop and give it back to the anchor. God bless.
Thank you, Mr. Chandrasekhar. May I now request our esteemed speaker, Mr. Jnanashekhar Tyagarajan, owner, Comtrends Research, to address the participants. Over to you, Mr. Tyagarajan.
Thank you, Chandrasekhar sir, as usual, for inviting me to, talk about something which has been very close to my heart, which is so passionate. It only takes me back to the early days, when I hope you remember in Pune, we used to go to all these institutes canvassing about commodity futures. Um, in the beginning, there has been a lot of aversion towards commodities as an asset class. In fact, the programs which I used to attend in CNBC, every second program, there would be a question on whether if I forget to square off the position, will I get delivery inside my house? This is a very, very common question which was there for some time. But I'm very happy to see now, people have gotten over all these aversions, and they're looking at commodities as an absolute asset class, and a lot of professionals coming into it. Just to give my own example, I think we're looking at different markets and people coming from different asset classes to commodities. And I'm one of them because I started off in equities and then I moved to Forex, where I worked for a bank where I kind of dabbled in a lot of foreign exchange trading. And from there moved into commodities. And that was a time when I think Business Line had offered me to write columns on commodities. That's when my interest in commodities grew a lot. And I thought, this is a wonderful opportunity and sector opening up. So that's when I started my career in commodities back in 2003. And it coincided with all the exchanges starting off commodity futures. And I'm very happy to be, looking back today, I'm extremely proud of being a part of an exchange which really did well in commodity futures. I was personally a part of the team which, was helping out in commodity futures, especially in crude oil, in palm oil. And I was involved in the entire process. And I'm very happy to see the way it has grown today. A lot of things have changed. I think in the initial stages, there was so much of doubts and wonder whether what has been achieved today will ever be possible. Because at that time, mutual funds getting into commodities or funds being allowed to trade into commodities were all an absolute dream. Options being introduced were all an absolute dream. We're all thinking that maybe in the next 20 years, 30 years, it might happen. But it's happened quite earlier than expected. So that's a great development. And the exchanges have also matured over time. I think they're doing a lot of knowledge and awareness sessions, and it's amazing to see that a lot of investors are able to benefit from that. I have a very small presentation, but since the time is less, if you want me to do that, I can just play some slides.
Yes, sir.
Yeah.
I have already given you permission.
Okay. So
Okay,
I just chose some, are you able to see the presentation?
Yes.
Okay. So this, according to me, is one of the best developments that have happened over time, where Sebi has allowed mutual funds and portfolio managers to take part in commodity derivatives, which is an absolutely amazing thing because you need a big player or big players to come into the market to provide larger liquidity, because this market is extremely liquid overseas, but in India you need funds, because in overseas there are so many funds and hedge funds which play a big role in commodity futures across the board. So that is something which is needed, and that's finally taken place, which is an amazing development. I think this is one of the best things that's happened. And from this point in time, one should not worry about liquidity, and this is going to be a major role. This will play a major role in bringing more and more liquidity into the market. If you look at the asset class and the way it is being positioned, first of all, you should understand the index. You know, the commodity index becomes the benchmark for most of the funds to invest overseas. In India, it's still not come up, but I'm sure some of the indices that have come up recently, with the metal index by MCX, are very innovative, and it's going to play a large role in getting more investor interest. So the index which you see here is basically the Bloomberg Commodity Index. And earlier it was another popular one was CRB Index and then Jeffries Index. But this is also very followed very closely by funds. The biggest chunk of the allocation will go to energy, because energy products are used across the world. So energy becomes top. And then comes industrial metals, because again the usage is across the globe. And then in agriculture you have grains, which takes a bigger part, and then precious metals now lately has grown. But if you look back at the index, let's say 20-30 years back, the top was crude oil, and the second important commodity after crude oil was coffee. And after coffee, it was cotton. And then came precious metals, then came industrial metals. But the whole composition has changed in a big way lately. It's now energy, and then it's industrial metals, and then precious metals, and then agriculture to some extent. And softs, where coffee comes, was a bigger portion earlier. Now it's a very minor portion. So this is broadly how investors allocate asset when they look at commodities as an asset class. They put this much in energy, 27% in energy, 19% in metals, 16% in precious metals. And then, the other commodities as per the opportunities that keep arising from time to time. So broadly, this is the index. I think most of the investment managers go by the index, and in fact, they rebalance it and shuffle it at the end of the year, depending on how the price movement was the previous year. So we are moving towards this, but I think finally we have to come to this where fund managers start investing based on the allocation and based on the indices. Now, if you look at the percentage of returns that it's given over the last decade, just the decade, of course, I can go even back, but I've just chosen a decade. Phenomenal investment. I mean, phenomenal returns by most of them, especially palladium, then platinum, gold. As it is, every year it's been giving decent returns. Then crude oil, substantial, but then you have huge flows. I mean, huge movement on both the sides, both negative and positive. But broadly, most of these commodities have given excellent returns over time. And needless to say, I think they would continue to do that in the coming decades as well, because you do have a lot of supply issues from time to time, and then the world is globally connected now, and there are interconnectivity between asset classes. So one thing that happens in one asset class affects the other asset classes. And having said that, I would like to highlight the importance of foreign exchange or the currency market, which plays an integral part as far as the commodity trade is concerned. Now, since most of the commodities that are traded in dollars are priced in dollars, it's very important to know where the dollar is headed, because if the dollar gets weaker, then the purchase power of the buyer who is buying the commodity increases. And if the dollar becomes stronger, then the purchase power goes down. So the dollar increase and decrease plays a substantial role in the commodity markets per se. And it's very important to sort of track it very, very closely. In fact, most of the days, the markets don't focus on the individual supply demand of commodities. Rather, it focuses on the foreign exchange and economic data that comes from time to time. And based on that, the commodity prices fluctuate in a very, very big way. So it's imperative for investors to watch and at the same time start taking cues from currency markets and effectively make strategies in commodities based on that. Just by looking at commodities specifically or in isolation is not going to help. It has to be married with other asset classes and specifically currency, because it plays a huge role. Now, coming to commodities as an asset class, the first thing that pops up is gold, because the way it is performed. And in India, it's close to our heart because it's a commodity which we buy in huge amounts. We're one of the largest buyers. We've been like that for a very, very long time. And it's given phenomenal returns the way things have shaped up over the past 20 years. And lately, post COVID, I think it's even more significantly established itself as a portfolio diversifier. When other assets are not doing well, gold is the one which performs the best. So the balance that it gives to any portfolio is just has been clearly established now. So it becomes a compulsory investment now for any portfolio. If suppose somebody is investing in equities, and in case there are going to be uncertainties there, immediately you turn to gold as a safe haven or as an insurance against any uncertainty. So gold is something which is done extremely well and going to continue doing that, because there is going to be uncertainties down the line, and with the kind of fiscal deficits that countries run and the amount of stimuluses that are being provided, it brings in huge liquidity, and most of it will be chasing assets like precious metals and of course other commodities as well, but predominantly precious metals. And it has proved itself as an asset class reliable to invest compared to other commodities which can get quite volatile. But somebody who has done an SIP in gold over the last 15 years would see amazing returns, probably the same as equities or even better than that. There are times in equities in the last 15-20 years where it has been wildly fluctuating. Of course, it's been on a bull run, but there have been huge volatility. But the steadier returns have come from precious metals. So the interest by retail investors and especially the Indian investors who had a lot of faith in gold only continues to be reaffirmed by the returns it's been giving over time. The typical characteristic of any asset class will be how much of yield it can give, what is the price return it can give, and whether it has volatility, whether it has liquidity. These were concerns initially, but I think we have gotten over all that. There's enough liquidity for most of the commodities. And even options which were recently introduced in gold have started doing well, picked up in a big way. Many of the corporates have also started using this market in a big way. And hedges, I must say that we're still possibly testing waters. Many of them are testing waters, and they still use international exchanges largely, because I'm associated with many corporates, so I kind of know that they still use international exchanges, because our domestic exchange liquidity has begun, but it's still a long way to go unless you have mutual funds and other bigger players come in. I think corporates won't have that kind of a confidence to come and sell that produce or buy that produce, big quantities which they bring in. So that's still going on, and I'm sure in the next 5 to 10 years we will see a lot of changes there as well, as more and more bigger players start coming into the market. Like I said before, the various asset classes like equities, fixed income, real estate, derivatives, alternative investments. This is where commodities come into as alternative investments. What was alternative investments are slowly becoming mainstream now. So the importance that commodities have taken in the global fund management business is amazing over the last 10 years. And thanks to the liquidity which many of these governments are provided by way of quantitative easing and stuff like that, many of these funds are awash with money, and then they don't know where to deploy it, and they start chasing every asset where they have a view on. But primarily, when you look at commodities as an asset class, I think you have the direct physical investment, you have commodity futures, and then you have commodity related stocks. Now, this is very important because when you know the thematic cycles that are happening, for example, base metals, when it bottomed out recently, most of our clients, we had a very clear view that there is a huge change happening. There's a supply-driven rise that's going to take place. So people go and buy stocks which companies, who either produce or consume these commodities, and how they're going to be benefited or affected. And accordingly, they invest in equities. In fact, many of the companies which are traded in the stock exchanges related to many of these commodities give far higher returns compared to the commodity itself. So there is a lot of interest that way, looking at thematic returns in commodity related products. So these are the different categories I think investors should explore. Commodity futures is of course quite volatile, and there's a lot of do's and don'ts one need to go through before really dabbling in it. I work with so many investors, funds, and corporates, and I see the retail investors are the one who take a lot of hits, and eventually they run away from the market. But before they get into it, if only they do some homework, if only they just blindly don't listen to rumors, and they do some homework and then start increasing their knowledge first before they get into the market, then it will be a wonderful place for retail investors also to trade. So that's where the speculation part comes at the top. The options and futures. They kind of speculative in nature, but then it definitely can be traded well with some discipline. So discipline in trading is extremely important. And in fact, we do a lot of sessions for many companies on educating them how to be more disciplined in their trading ways. So for retail investors also, we see there's a lot of need to educate them to be more disciplined in trading, more than teaching them fundamentals and more than teaching them supply demand about commodities. First, there is a need to teach them how to trade and approach this market, not approach it like equity markets where you buy and you forget the stock, and after a point in time it will appreciate on its own. You can't do that in commodities because the retracements are quite sharp. So that's an approach you need to have separately for commodities, where you have to be absolutely clear, keep booking profits at every level, keep adhering to stop losses. These are all very, very important. Otherwise, the profits you make will be eroded in no time. So the fundamentals and technicals play a big role. But today, unfortunately, what I see is that many of these players who have started coming into the market lately relied too much on technicals and ignored the fundamental part most of the time. In fact, many analysts that I am aware of don't even know about the basics of these commodities. They only know about the charts, they know about the price movement, and they feel that they capture the momentum and that's good enough for them. I know someone who didn't know whether soybean was grown below the ground or above the ground. That's the nature of many of the traders these days. They all come out of colleges, they all come out of investment schools, and just start dabbling in it purely based on charts. That's a very dangerous trend. It's very important to know what asset class you're trading in, and very important to know the fundamentals. I'm not saying technicals is not good, but it is good if you combine it with fundamentals, and it becomes very, very effective if you know both. And that way I'm very, very thankful to Sir, because Chandrasekhar Sir, because I have learned a lot of fundamentals from him, and that has helped me mature as a trader over time. So not just purely focusing on technical analysis alone. But it is very important to use technicals and get a direction in the market, but definitely have to use fundamentals and marry it with technicals to get a clearer view about the market. The other thing I see is the algo market, which has completely distorted the overall commodities as an asset class. You can't do anything about it. I think we have to live with it, because they provide a lot of liquidity as well. But these exaggerated movements take place, and that affects the industry in a big way. Many of the players in the industry, they have their own pricing when they do, either for production or for consumption, and that just gets completely distorted because of these exaggerated movements. I only wish that something comes up where the regulator is able to kind of put some effective mechanisms to ensure that it doesn't distort prices in a big way. It is needed, but it shouldn't distort in a big way. So you need to be careful about that. I think retail investors and other investors suffer a lot because of this, but it is a need, and we have to live with it. So with that, I would end this presentation by saying that it's an asset class that is going to play a huge role. Like Chandrasekhar Sir said, commodities as an asset class is probably 10 times bigger than equities overseas, but in India, it's still in India. In India, the way we look at commodities is purely as derivatives, but there is a bigger OTC market for commodities overseas, and that OTC market is still not a perfect market here in India. It's still a cash market. So I think if there are more changes that come, then this asset class is going to do wonders, and this asset class is where one should be invested going forward too. Once again, thank you for the opportunity, sir. Thank you very much.
Thank you, Mr. Tyagarajan. May I now request our next speaker, Mr. Rishi Nathani, Head Business Development and Marketing, MCX Limited, to address the participants. Over to you, Mr. Nathani. Kindly unmute yourself, sir.
Thank you. It's a pleasure to be here with IMC and with Mr. Chandrasekhar in the second time in the week. Very nice topic, commodities as an asset class, and I'd like to, while Mr. Gyan Shekhar and Mr. Chandrasekhar both, they're both crest jewels because they're both Shekhars, have already spoken so much about knowledge. I will also try to talk a little bit about commodities. So commodities are a very distinct asset class compared to other asset classes because their returns are very different from other asset classes. So if you see that commodities gives you a very different return quality compared to other asset classes. So, within commodities, against equities or fixed income instruments, if you see that commodities have an inverse correlation to fixed income instruments and equities. So when fixed income instruments on equities don't do so well, then commodities do well and vice versa. So they give you a lot of portfolio diversification as well as help you to reduce the risk or standard deviation of your portfolio. So in that sense, one should always have commodities in a portfolio. And I would like to, I would liken it to an example that when you eating, while you eat salty food, you also have sweets. So similarly, when you have equities and bonds, you also have commodities. So enhances the taste of the other. So in a portfolio, it should be and like you have a balanced meal with all your carbohydrates, fats, proteins, etc. Similarly, you should have, while you have equities, fixed income, real estate, and insurance in your portfolio, you should also have commodities in your portfolio. So it will give you a wholesome experience and a very healthy diet for your investments. So in that sense, you should definitely look at commodities. And how many people ask, how much allocation should I have towards commodities? So there is no specific answer because it all depends on your risk profile and the time horizon with which you are investing. So for that, you need to consult your financial advisor, but definitely you should look at having commodities in your portfolio. Another reason to have commodities in your portfolio is that commodities do well in periods of inflation, because actually inflation is nothing but increasing prices of various goods and services, which include commodities. So if you want to protect your portfolio against inflation, you should definitely invest in commodity. Another factor is that when you see that if you want to safeguard yourself against currency volatility, then also internationally referenced commodities are ideal to have in your portfolio. So for example, if you invest in gold and the price of gold internationally does not move, but the rupee falls against the dollar, then automatically the price of the gold domestically will rise. So if you are looking to hedge yourself in terms of forex exposure, so for example, if you want to send your children abroad for studying, or you want to take annual foreign holidays or whatever, so a certain part of your assets should be invested in asset classes which are hedged against foreign currency, and internationally referenced commodities are ideal for it. Another advantage for commodities is that they are tangible or real assets. So it is common human psyche that you want to invest in something you can see, feel, hold, touch. So that is why historically our forefathers have been investing in land and gold. Another reason why they did that is that financialization of asset classes was not there to large extent. But now everything is financialized. And I have seen that as financialization happens, more and more people participate in any asset class. So for example, in equities, they really took off in the late 90s when DMAT came in. After that, you saw volumes grow manifold because the risk of bad delivery, etc., went away. And as Mr. Gyan Shekhar said, the first question he used to face is that if I buy commodities and if delivery comes, will it land up at my doorstep? Now, that is not a worry anymore for two reasons. One is that now commodities also DMAT is possible. So if you want, you can take DMAT delivery of whatever you are buying. And if you want to take physical also, you can take physical delivery. However, the goods are in the warehouse, you can go and take delivery of them. So because of this financialization or dematerialization of commodities, you will, so basically the commodity in equities, the share certificate is extinguished and an electronic balance is created. So it's dematerialized. In commodities, the commodity itself cannot be extinguished. The commodity is there in the warehouse. It is the warehouse receipt, which is the proof of ownership of that commodity, which is dematerialized. And there you get that, and you can trade that warehouse receipt, which is called an electronic non-negotiable warehouse receipt. You can trade that warehouse receipt and take and give delivery of goods. So in that sense, it is very easy now for financial participants who do not have the physical market wherewithal or do not have that kind of national reach also to participate in commodities to a large extent. Now, commodities are also, as Mr. Chandrasekhar said in the beginning, are a raw material for economic activity. So whatever, it touches our daily life. So whatever you are wearing, whatever you are eating, whatever with the place you are sitting in, everything is commodities. So commodities is an inherent part of our life. And many people say, oh, should I invest in commodities? And I ask them, you are already invested in commodities. Every human is invested in commodities because in your house, if I go in every house, there will be some grains, there will be some other gold, there will be some metal, there will be some commodity or the other. So we are all invested in commodities. It is only a matter of financializing that investment. So that is where it is so important. So I feel I rue the fact that it's so near and yet so far, because most people are invested in commodities. Everyone is invested in commodities, but yet coming to the commodities markets and investing is something people need to do on a regular basis. So that is why people should definitely look at commodities as an investment class. And I heard that I think it was Mr. Janshekhar, I don't remember, was saying that commodities, or Mr. Chandrasekhar, I think, that commodity markets in India are very small compared to the foreign markets abroad. And I'll just give you a statistic that commodity derivatives markets are around 4% of the entire, uh, market turnover in India, whereas abroad it is around 24%. We have a long, long way to go in terms of getting people to invest in commodities. So, there are a lot of, and now there are a lot of innovative products in commodities. So thanks to the regulator Sebi, which took over in 2015, the reins of the commodity markets, we got a lot of products and participants. In terms of products, earlier we only had futures. Then we got options on futures. Then we got options on goods, and now we have index futures. And we all of them are doing very well, and they are a very good way of investing. So for those people who do not want to give or take delivery, you can also get index futures. You can take exposure to index futures. And in terms of participants, we have got a lot of participants into the markets. It's starting with category 3 AIFs or hedge funds. And then you have key portfolio management services. Then you have mutual funds, you have banks and bank broking subsidiaries, uh, eligible foreign entities. So a lot of people have been allowed into the commodity markets. And we have seen two mutual funds launching their schemes also and participating actively in the commodity markets. And I hope that a lot of them will further come and participate in the commodity markets. And for investors, I would like to say that, always you should do your due study and invest in the markets. If you have the time and the ability to do your own research, please do that. If in case you don't, then trust your investments to a professional, whether it's a mutual fund portfolio manager or an AIF. So you should investigate, then invest. That is in World Investor Week, that is my slogan to you: investigate, then invest. And commodities are a very vibrant market. They are growing by leaps and bounds. And Mr. Chandrasekhar is, how do you say it, he's the Bhishma Pitama of the commodity markets in India. And, under his guidance, we are all working to take the commodity markets further. And I would seriously urge you all to definitely look at commodity markets. You can even look at an income, there are so many deliverable contracts where you can do an SIP in 1 gram gold or 1 kg silver and things like that. So there are a lot of opportunities for you to do SIP, to do delivery, to do hedging. So please do look at these markets, and please do access them, but do it in a very knowledgeable and safe way. Thank you so much.
Thank you, Rishi, for these words of wisdom. Extremely important. I also want to thank Gnanashekhar for certain insights that he brought to this subject. Because we are in the World Investment Week, the theme is obviously investor awareness. For the financial well-being of investors, we need to create greater and greater awareness amongst market participants about the opportunities in commodity markets. Now, all the speakers have insisted, have said that don't jump into commodities, study, research, gain some product knowledge, gain some market knowledge. But for those who don't have time to study product knowledge and market knowledge, then you have mutual funds, and you also now have index. And therefore, index is a very secular investment opportunity. And you don't need any specific commodity specific expertise when you invest in index. And therefore that is again another easy way of getting into commodity market. While our own research is extremely important, if there are constraints to learning and understanding these market dynamics, trading in index would make a lot of sense. Rishi, would you like to speak a little more about investing in index and the benefits?
So thank you, Mr. Chandrasekhar. Index futures are an ideal way for a lot of people who do not want to give and take delivery to invest in these markets. So if you can have a lot of hedgers. Say, for example, you have a hedger who's not uh, trading or manufacturing the same quality which is traded on the exchange. So definitely you can't give or take delivery, but your price is linked to that commodity. So for example, a fan manufacturer might be buying aluminum blades of a different quality than what is traded, so but they have an exposure to raw aluminum. Maybe they are buying the blades directly, so they're not buying the ingots and melting them to make the blade. They might be buying the blades directly, but they have an exposure to the aluminum price, so they can hedge through these indices. Then there are a lot of investors, there are a lot of traders who do not want to take or give delivery, and you will find a lot of interest from the institutional participants, because uh, institutional participants might want to make structured products or ready-made portfolios out of these indices. So let me give you an example. Like for example, the MCX ICOMDEX base metal index, which we call the metal dex, has all the 5 base metals in it. So if someone wants to take an exposure to base metals, they can just take the index rather than take exposure to each contract separately. So an index in that sense gives you a very good portfolio, and voila, you have a commodities portfolio of 5 base metals. Similarly, in bullion, you have gold and silver together. So you don't need to second guess as to what will go up, what won't go up. Another thing is that indices also help to trade the market direction in a very good way. For example, so let me give like equity markets. If you're bullish on markets, you buy. If you're bearish, you sell. In commodity markets, you can do both at the same time. So if you're bullish on the economy, you buy energy products or base metal products. If you're bearish, you buy bullion products, because bullion is seen as a safe haven against global economic uncertainty. So you have all products to suit all types of economic situations. And these indices being a very small size. So for example, if you took an exposure to the underlying in the bull dex, which is 1 kg gold and 30 kg silver, you would have a roughly 70 lakh exposure, which you can get at 7.5 lakhs in the bull dex. So it is a smaller contract, makes it more affordable for smaller investors. So in that sense, index futures, and there are index futures on other exchanges also. So NCDEX also has its AgriDex. So every exchange will go on launching these index futures. And index futures are a great way to access these markets. You don't have to worry about delivery. You don't have to worry about, so you can leave the position till the end. It will automatically get cash settled. So for passive investors, it's a great way to build your portfolio. So Mr. Chandrasekhar, if you want me to speak on anything else, please do let me know.
No, perfect. No, I think this is great. In fact, I'll of course next ask Jnana to add something more if he wants to. But what is important is in India, we have a huge amount of household savings. Household savings, 30% of the income is saved actually in India, and all these household savings are more often than not in fixed income, in say assets like bank fixed deposits. A small part is probably going to mutual funds now, and even less to the stock market. I think commodities must now start attracting retail investment. The savers can obviously have some money in fixed deposit in the bank, but a part of that saving can also, as there is a great potential for that money to come into the commodity market, which will happen if and only if and when on a continuous basis we start teaching, training, and educating retail investors, which is what IMC and MCX have been jointly doing over the last 3 or 4 years. But it's a massive challenge. We need to keep doing it quite often. I think that's very interesting. Number one. Number two, as Rishi mentioned, in a rising market, people want to invest because it does not need any great intelligence to invest in a rising market. You buy today hoping that the share or the commodity will prices will rise over the coming days, coming months, and then you will sell and make money, which is called going long. Going long is easy, but believe me, when you go short, that is when you sell, when you don't have the material in your hand, you expect the prices to fall and you will buy back when the prices fall. That is going short, which happens during a bear market. more money is actually made in a bear market than in a bull market. And therefore, the commodities market facilitate both a bullish run for in commodity prices, and also a bearish trend in commodity prices. And therefore, one, as Rishi mentioned, can make money on both sides, provided you have adequate product knowledge and adequate market knowledge. It gives you extraordinary opportunity. And in a country like India, where our economy is substantially integrated with the global economy. Our markets are substantially linked to the global markets. Uh, our commodity markets are influenced not only by domestic factors of demand and supply, etc., but also by the global factors of economic growth, monetary policy, geopolitics, currency movement, global weather, etc., etc. Therefore, all these need to be tracked, very, very important. But this kind of volatility also creates newer opportunities for those with adequate risk appetite. For them, the commodities offer an extraordinary opportunity and to get very, very attractive returns. Yes, very nice. Jnana, you have something to add beyond what you've said? Yeah.
Yeah, absolutely, sir. Essentially, for investors who want to look at commodities as an asset class, I think the best way to start, even at this stage, is to follow the price very, very closely. When you do that, you will automatically come to know all the factors that drive the price over a period of time. Then you start questioning why it went up, why it went down. That's how you start increasing your knowledge in commodity markets. All these seminars are fine, all these classes are fine, but eventually it's the price which will help you. So price is your friend, and price helps you in identifying a trend. That's how I learned, because when I started, I had no idea about commodities. I only knew about charts and how the price movement happened. But then eventually I started looking at questioning all the price moves, and explored that there are certain fundamental factors that influences, and what are they. And from time to time, there are certain patterns that keep coming. And commodities are seasonal in nature. It's far easier to trade commodity as an asset class compared to other asset classes, because you have a seasonal nature. For sure, you have a crop coming in at this time, and for sure you will have a supply increasing at a particular time. So it makes analysis slightly more easier compared to asset classes. So it's not as dangerous as speculative as being told. With that, I'd like to emphasize that someone who's starting has to start tracking the price very closely, and then over time they will automatically come to know everything that influences the price.
Very well said. Very well said, Jnana. I completely agree with you, because I teach markets in a number of B schools. I keep telling students that don't try and learn too many commodities in one shot. You pick up one agriculture commodity, pick up one non-agriculture commodity, study where is it produced, where is it consumed, what is the supply chain, how is it traded, what are the factors that drive prices, seasonality, for example, all that. Once you get reasonable amount of product knowledge and market knowledge, quality specifications, etc., and then you look at how prices have behaved in the previous 6 months or 1 year, look at all the drivers that drove prices up or down. Then I tell them that you test yourself on, say, gold prices or crude oil or cotton or sugar. Where would prices be 3 months or 6 months from now? You test yourself. You don't have to discuss with anybody. You just test yourself where prices are going, and see whether your thought process is correct. Or if you're right, you should be surprised that you are right. But if your price forecast goes wrong, inquire why it has gone wrong, what are the factors that have come into play, etc. Therefore, I think this is extremely important. There's knowledge, this introspection, the study, the research is extremely important for winning in commodity markets and for investing in commodity markets. I find from the chat box there are no questions at all. If there are no questions, I normally assume that all the learned speakers have left no one in any doubt whatsoever, that they have clarified all the doubts of people. And if we assume it this way, and because there are no questions in the chat box, maybe we should actually conclude. Rishi, if it's okay with you, Jana, if it's okay with you, if there is nothing more to add, let us conclude this webinar on commodities as an asset class, organized by the IMC Chamber of Commerce and MCX for the benefit of investors during this week, World Investment Week, announced by the Sebi, which is the market regulator. Rishi, can we conclude this if we have nothing more to add?
Sure. Thank you. Thank you.
Right. Jana, can we conclude this?
Absolutely.
Okay. So let me say good luck and God bless you all. We'll meet again soon. Thank you.
Thank you very much. Thank you, everybody. Thank you. Thank you.